Another week has rolled by, and the financial storm seems to be gathering strength. The major headlines scream of increasing interest rates and a chaotic House of Representatives, causing markets to tremble. Welcome to Invest Growth Wisdom. If this is your first encounter with us, I'm here to guide you through the tempest, helping you spot opportunities amidst the chaos. Today, I've identified 7 investment opportunities that stand tall in these turbulent times. But before we get into that, just a brief flashback. Over the past week, most investors' portfolios dipped down, and if you've experienced a similar downtrend, stay composed. I'd advise against hitting the panic button. These phases are golden opportunities for those with a long-term investment perspective. I've always cautioned about the impending market jitters due to underlying economic factors. If you've been following us, you'd know how vital understanding macroeconomic factors is. And if you found this content insightful so far, don't forget to subscribe to Invest Growth Wisdom for more insights. Before we dive in, let's address the elephant in the room, the much talked about government shutdown. Such an eventuality could spell a paycheck freeze for millions, including our military personnel. At first glance, the prospect sounds horrific, doesn't it? However, let's gain some perspective. Actual government shutdowns are rare. Even if they occur, they're short-lived. Rather than being consumed by short-term concerns, our focus should be on long-term strategies and financial growth. Now, let's delve into the factors currently shaking the market to its core: inflation, interest rates, and the looming shadow of another round of government shutdown in a month's time. To offer a snapshot, after a period of decline, inflation is showing signs of resurgence, currently hovering around 3.7%. This figure is way above the Federal Reserve's 2% target, a mark we might not hit for some time. What's unnerving many is Federal Reserve Chairman Powell's stance on interest rates. Speculations abound about another rate hike by year-end. Even more, there's talk of maintaining elevated rates till the end of 2024. This leads to questions about how businesses will adapt and thrive. The evolving scenario underscores a survival of the fittest scenario. As investors, our challenge lies in identifying businesses that are led by competent teams, a recognizable brand, and a robust financial structure. The 7 dividend stocks I'm about to discuss possess all these traits. Starting our stock exploration, the first is Visa, ticker symbol V. Beyond the simplicity of card swipes lies a financial titan with a market capitalization of $460 billion, ensuring smooth transactions for over 4.2 billion cards globally. With a recent dip from $247 to $231, the long-term outlook remains bright. Eyeing a past growth of 54% over 5 years, the future beckons with a predicted rise of 23%, pushing its value towards $284.41. What makes Visa so attractive is its impressive 14-year stretch of dividend growth, boasting a 16.89% rate and yielding about 0.78% with immense potential for growth. Another stock worth your attention is Waste Management, with its ticker symbol WM, is a unique yet solid choice. Though it's not the most glamorous of stocks, its current value of $151, down from a peak of $173, showcases its potential. Over 5 years, we're looking at a significant 68% growth. With an unparalleled reputation in North America and minimal competition, it's hard to imagine a world without waste management. Predictions? A potential rise to $180.46 per share, translating to an increase of 19.34%. And for those dividend hunters, it promises a solid growth rate of 8.61% over the past 5 years, offering a dividend yield of about 1.84%. Continuing with our stock journey, next is Microsoft. From its soaring heights of almost $360, it's been brought down to earth, settling at about $321. That's a 2.23% dip in a recent month. But here's where it gets interesting. Over half a decade, this giant displayed a stunning growth of almost 179.5%. Recent trends show big players cashing in their chips, with substantial sell-offs like Kathleen Hogan's whopping $8.7 million worth of shares. But remember, as we set our sights on the horizon, analysts are predicting a potential upswing of 23.5%, pegging its value near $397. But what's truly golden about Microsoft? the staggering 18-year dividend growth, averaging at 10.12%. Meaning, you get to enjoy a steadily expanding dividend, currently standing at a yield of 0.95%. Next on our list is from the home improvement sector, Home Depot, symbol HD. Despite the current shift in consumer behavior and a potential slowdown in DIY projects, history shows us a robust 46% growth in the past 5 years. At $299 per share now, bullish analysts foresee a 17% surge, potentially reaching $350.74. The mixed insider opinions make this one to watch closely. And for those who appreciate consistency, a 13-year dividend growth streak at 15.47%, yielding 2.77%, is hard to overlook. Now, shifting our lens to the defense sector, Lockheed Martin, symbol LMT, stands out. As the leading defense contractor globally, Lockheed crafts advanced battlefield technology, military vehicles, and aircraft, with the U.S. government being its primary client. Despite the recent dip in defense spending worldwide, the long-term outlook remains bright. Eyeing the 5-year chart reveals a 16% growth. Insider activities also suggest confidence in this defense juggernaut. With lucrative contracts in their pocket, like the $104 million deal with the U.S. Army and Navy contracts worth $296 million, Lockheed remains steadfast. Analysts forecast a bounce of over 22%, potentially touching $497 per share. Their dividend story is equally compelling, with a 20-year growth history, an 8.45% growth rate, and a current yield of 2.93%. Switching gears to fast food, McDonald's, symbol MCD. Beyond their world-famous burgers and fries, McDonald's stands as a colossal real estate tycoon, boasting ownership of land and buildings valued at over $192 billion globally. These are then leased to franchisees across the continents. With consistent growth and a promising future, it's a stock every investor should watch. McDonald's, currently trading at $257.75 per share, might not be your typical bargain buy, but remember, we're talking about a global titan here. With a growth of over 56% in the last half-decade and a projected 28.4% rise to reach the $331 mark, it's clear to see why hedge funds have been snapping up shares. But what truly captivates me? Their consistent dividend offering at a hearty 2.31% yield, growing at an 8.52% rate for more than 2 decades. However, if fast food isn't quite your preference, perhaps the aroma of Starbucks, symbol SBUX, will draw you in. This coffee giant has expanded its presence to over 35,000 locations around the world. With its current share price of $91.13, it seems like a ripe opportunity, especially when considering its 63.9% growth over the last 5 years. Hedge funds certainly think so, buying up over 500,000 shares recently. And while sipping their brews is delightful, as investors, we also relish their 2.5% dividend yield, growing at 10.97% for the past dozen years. Starbucks has the potential to rise to $114.31 per share, translating to an increase of 25.5%. Wrapping things up, the economic terrain is ever evolving, and while the winds might be rough, steering with insight and wisdom ensures smooth sailing. Alright, Invest Growth Wisdom family, if you found this deep dive insightful and valuable, please hit that thumbs up. It means the world to us. And if you haven't already, consider subscribing. We're committed to bringing you top-notch investment insights,